Let me also welcome on board Sandeep Kalra, the ED and CEO at Persistent Systems, to chat about their numbers. Sandeep, hi, morning. What stood out to me in your earnings this time around was that you've almost added about 9% of your workforce strength this quarter. What's giving you this kind of confidence about demand visibility for the medium term?
So for the quarter, we brought in about 1,610 new colleagues. This included 700 from our Data Glove acquisition. Now, if you look at the demand environment, from our perspective, we are looking at a healthy demand environment. We have a fairly good pipeline. We spent the last 3 to 4 weeks in the field meeting our partners, whether it is people from Google, Microsoft, IBM, Amazon, a number of our customers. A lot of them are relatively bullish about the prospects. Obviously, everyone is watching the macroeconomic environment, whether it is Russia-Ukraine conflict, whether it is the inflation in the US. But from a short to medium term, there is no worry about the pipeline, as we see from our partners. And even if you look at the results announced by Microsoft and Google in the last few days, their cloud revenues have significantly grown and continue to be robust. So from that perspective, whether it is these partners or our partners like Salesforce, these are the 5 bigger technology partners from us. For us, the perspective on the way they are looking at demand, the way it downstream translates into demand for us, the pipeline that we are seeing, all of that is relatively healthy. So that should be, giving an answer to your query.
Now, TCV rose for the 5th consecutive quarter. Will this plateau around the $350 mark, or do you think it's headed towards $400 million?
Right. So the way to look at these TCV wins, I would say you should look at the full year, because we build a pipeline, we close some deals, we keep on building our pipeline for the future. So there will be quarters where this 360, maybe 300, maybe 400. I would rather focus on the bigger picture, which is the full year. If you look at the full year TCV for FY22, for example, we did $1.22 billion. The annual contract value component of this is $943 million. So if you look at the slightly bigger picture, it is fairly healthy. It is trending in the right direction. It is giving us enough cushion for the growth that we aspire to have.
Now, Mr. Kalra, you have managed to maintain margins despite the acquisitions that you've undertaken as well as supply side issues. So what kind of levers do you think are supporting the operational performance? Do you think we'll see better realizations going forward?
So on the margin front, obviously there are puts and takes. So on one side, yes, there are things like attrition, there are things like salary costs, many other factors. But on the other side, look, the positives for us are the revenue increase, the trajectory that we have. This is the 4th quarter in a row. We have grown by 9.1% or thereabouts sequentially. So the growth definitely gives us a good lever. The other side is the services that we perform for our customers are more on the forward-looking side. They are more related to the cloud side, digital transformation side. And we have a good propensity to win businesses with a higher rate as we are going along. And the customers are willing to do it given the inflation in the US, which is our biggest market. Similarly, we have been seeing an ability to increase prices whenever the contracts are up for renewal, whether it is in US, Europe, or rest of the world. So there are puts and takes, and we are relatively confident. While we have done acquisitions, while there will be related charges on things like amortization, etc., we are trying to keep our margins relatively flat to what we have been able to improve year on year. So year on year, we have improved margins by about 180 basis points, and we expect there may be short terms, ups and downs, but over a longer period of time, we expect to be at the same level.
Mr. Kalra, good morning. This is Nantara joining in. So if I were to see this revenue growth of 35% and the margins of 14 to 15%, I think what the shareholders, analysts, viewers will want to know, is this sustainable? Are you going to expand on it, or will it compress?
So look, we don't give forward-looking guidance, but if you translate and juxtapose the deal wins that we have had fairly robust deal wins quarter on quarter. We have delivered for the last many quarters sequentially based on the revenue conversion from those deals. We have put together a very strong set of capabilities organically and through the acquisitions that we have. We have a fairly good pipeline. So I will not quantify whether it will be 35% growth or whatever, but we are looking at a fairly healthy continuation of growth sequentially and on a yearly basis. So we remain bullish on our prospects. We have very good partnerships, very good pipeline, and I'll leave it there.
Okay, appreciate that, even though you don't give forward guidance. The other thing, we're talking at a time when wage inflation is going up. It's a global phenomenon. Attritions around the world are at, lifetime highs when we talk about this industry at large. For you, wage inflation in the US is usually 1 to 2%. Where is it now?
From a US perspective, you are right. In a normal year, one would look at 2 to 3% wage increases year on year. In the current inflationary scenario, where the US inflation is touching about 8.5%, the average salary increase would be somewhere in the range of 4 to 6%. And that will also depend on whether the skill sets, what kind of skill sets are there, what kind of longevity with the company, and so on. But we are definitely looking at a much higher wage increase in the US this year around as compared to the earlier years.
Right. So, that then is a sizable spike, and all of this is clearly passed on as higher realizations, I'm assuming.
Yeah, so obviously in any business, these are our supply chain is our people side of the house. And that's the biggest asset. In software services, that is the biggest asset we bring to bear. We don't have any factories, etc., producing goods, right? So the other side of it is, the contra to that is, when the customers themselves look at their own staff and they are looking at their own salary, the wage bills going up, when we go back to them and ask for rate increases, they are more amenable to that, because that's a market reality. So yeah, on one side there'll be wage increases, on the other side there'll be rate increases as well. So it's a balancing act that we will have to operationally be efficient on.
Sure. So, what about India, and what's the wage inflation that you expect this year?
So typical wage increases in India that we are looking at in this year will be in the range of 10 to 12%, somewhere in that range.
Would compare to the 7 to 9% in a usual year?
Yes, you're right. In a usual year, it would have been somewhere between 7 to 9%. This year, it'll be higher given whatever is happening in the market, whether it is from a talent perspective. There's good demand in the market. There's attrition and other factors. So there's going to be a little higher wage increase this time.
Appreciate your time, Mr. Kalra. Thanks so much for joining in and giving us a view as to what the earnings have been like for the company.